Today, we are going to talk about whole life insurance and the two main ways you can buy a whole life insurance policy. So we've got whole life policy A and then whole life policy B. In this video, we're going to assume that these are the exact same policy with the exact same company. We're just going to approach them different because you can do this with a whole life insurance policy. This creates the "oh, I didn't know that" moment. You ever learn something like that? I didn't know you could do that. You'll see exactly where I'm going here. So let's begin with approach A. So with a whole life insurance policy, starting with the very basics, what you get is as follows. You see a death benefit. This is the actual life insurance benefit that is paid out if you die. You pay a premium to get that death benefit. And you also have cash value that builds up over time. Now you see these two terms down here, guaranteed rate and dividend rate. What you'll see with a whole life insurance policy is a guaranteed rate. This is the minimum guaranteed rate that is applied to your cash value. The guaranteed rate will range depending on the company and product you select. A common guaranteed rate we see with a lot of products today is 3%. It's going to range between 2% and 3.75%. Years ago, it was 4%. However, that no longer exists unless you have an old policy that has a 4% guaranteed rate. But it's very common to see a 3% guaranteed rate. However, the dividend rate is the total rate the company is applying to whole life insurance policies. So we might see a dividend rate of 6%. So you do not receive the guaranteed rate and the dividend rate, which would be 9%. No, that would be nice. We get just the dividend rate. So the dividend rate includes the guaranteed rate. So what we've got here are three items. First, we see the death benefit. This is money that is paid to your beneficiaries if you die. If you die, family gets money. Then we've got the premium. This is what you pay. And then we've got the cash value. This is your money that you can use today, meaning you do not have to wait until you die like any other life insurance policy before we actually see any money. The cash value is very appealing. So a couple points on the cash value here, because this is always an area of attraction. The cash value in a life insurance policy, you will see grows without any risk. I can use it like a line of credit, and I can also take income in retirement on a tax-free basis. A lot of people will take out whole life insurance for this reason only, the cash value benefit. And here's typically the three reasons why. Grows without any risk, safe place to put money. I can use it like a personal line of credit. What that means is you can borrow against it if you've got $100,000 in cash value that's earning 4 or 5%. You can take $50,000 and you continue to earn that 4 or 5% on the full $100,000. So the money keeps on cranking for you. I do have to pay interest on the amount I borrow, so that'll offset the gains a little bit. But how a lot of people view it is a lot like real estate. If someone owns a piece of property, it's appreciating at 5%, I can take a line of credit or mortgage against it, and that fair market value, that 5% appreciation, continues to be applied to my entire property value. And then lastly, I can take income on a tax-free basis down the road. A lot of people are attracted to that. So those are some nice benefits to the cash value. Does it pique your interest in whole life insurance at all? Maybe, maybe not. If not, that's okay. Here's why people typically don't like it though. So I've got a premium that's typically very high. Let's pretend for this example, you buy a death benefit of $1 million. And you say, how much is it going to cost me? The answer might be $20,000 per year. Could be more or less. That's a lot. Per year. Not $20,000 total, per year. So you pay that $20,000 every year. Let's assume you pay into it for 20 years. You've got your cash value down here. First year, you're at zero. You paid 20 grand, there's nothing to show for it. As time passes, this cash value builds up. Notice, right around the 10 to 15 year mark, your cash value is equal to your total premium payments. So what that means, if it's at year 15, if you've paid $20K per year for 15 years, how much is that? That's 300 grand. So what I'm attempting to convey with this chart is by the 15th year, your cash value is finally worth $300,000. All of the years prior to that, you had cash value that was building up, but it was less than what you paid in. So you had a negative return on your cash value. Now you had a death benefit that if you die, that's paid out income tax free. And that continues to appreciate over time. It goes up in value, but the cash value piece taking a long time to build up any real value. So you've got the benefits down here. Here's typically why people like the cash value. But let me ask this. Are those benefits worth it if it takes 15 years just to get your money back? Probably not. It's not worth it to me. And this is what I do for a living. Like, it just takes too long to build up the value. Like, there's other things I could do with my money if I was just comparing this to other asset classes and such. The death benefit is nice. And I'll also add this point. After 20 years, you can stop paying altogether and watch that cash value continue to appreciate. Or you can keep on adding money to the policy. So you can set it up to have the option to stop funding early or keep on pumping money into it. But this is a very straightforward approach. I say, here's a life insurance policy of $1 million. It costs you $20,000 per year. You've got no cash value in the beginning. Takes a long time to build up. And eventually, you'll really like the benefits that you see. Want it? Probably not. This is actually the most common type of whole life insurance policy or setup that is sold. When you look at whole life insurance sales in the industry, more than 90% of sales are done in this manner, where someone's told, here's a death benefit, here's the premium. The person just pays the premium, sees no value in the beginning, and if they hold on to that policy, eventually they see the value. But they've really got to just tough out the early years, or they've got to be in a strong financial position where that doesn't bother them. It bothers most people because this is our money going into the product. So how do we overcome that? Because that's not attractive if you're interested in the cash value. Let's look at approach B though. So we're going to take the same product with the same company, but set it up where we emphasize this instead of the life insurance. A lot of people are not aware of this. So instead of me saying, here's a $1 million death benefit, it costs X amount of dollars, instead of taking that approach, you, the policyholder, can say, I'm interested in this. Here's how much money I'd like to pay into the policy. For the sake of simplicity, what was the premium over here? $20,000 per year. Let's just pretend you said, I want to pay $20,000 per year into this policy. So we're going to pay a total of $20,000 per year. What'll happen is you have a death benefit that starts out closer to $400,000 instead of $1 million. When you make that payment, we'll assume you're going to pay it for the same 20 years. The first year, your cash value won't be a zero. First year, it's going to be $18,000. It's going to be between 17 and 18K. But instead of a zero, it's very cash rich right out of the gates. In addition to that, by the fifth year, come on. You get your money back. So if you've paid $20,000 per year for 5 years, that's how much? $100K. You have how much by year 5? $100K. You're getting your money back much earlier as opposed to waiting 15 years like you did over here. So we can get it back a lot sooner. What's the difference? Like, how do we do this with a whole life insurance policy? Here's the key on this. So here's a common strategy we see. Someone has cash in the bank and they're interested in a whole life insurance policy because of the cash value benefits, the safety, the liquidity, and being able to access it tax-free. So again, instead of me saying, here's how much it costs, you can say, I want to move this lump sum into the policy. And then what we're going to do is say, okay, let's do it this way. We're going to put $100K per year for 5 years into the policy with a priority of maximizing the cash value. So we'll set that premium piece at $10,000. Then we have money going here in blue toward what is called a PUA rider. I like to call this a cash dump-in. Dollars that you pay toward the premium. Remember that $20,000 example? Whole life policy A. What was your cash value in the first year? It was 0. So here, whatever the premium is, whether it's 10K, 20K, whatever, it does not show up in cash value in the first year. Reason why is because it buys you a death benefit initially. Whereas PUA dollars, guess what happens here? They show up in cash value right out of the gates. Now you won't see the full payment show up in cash value. Usually it's right around 95%. So $85,000 or so, you'll see the bulk show up in cash value immediately, which is nice. We'll get you some death benefit. However, we're putting money here because we see it show up in cash value. This is money you can access right away. It begins to compound. This is really the key to maximizing the cash value growth on a whole life insurance policy. And then also, we want to make sure we avoid a MEC, which stands for Modified Endowment Contract. This would trigger a taxable event. So what we're doing here is maximizing the cash value of the life insurance policy. So if you're funding, this is $100,000 per year. This is a common approach. And if you hear me say that, you say $100,000 per year is a common approach, like what, just a bunch of bigwigs do this only? No. So it's common to see someone with a lot of money in cash move it into a policy. Could be the same thing if I have a total of $50,000 and I move $10,000 per year into a policy. It's all relative. So we can peel a 0 off, we can add a 0, as long as we're doing it like what we see over here, where we are really reducing the premium. 10% is often as low as we can go with a lot of the top companies. If we take that approach, that's where we'll see a high cash value policy. So back to our chart over here. If he's funding that $100K per year, what do we have? Well, you've got $10,000 going toward the premium, $90,000 toward PUAs. How long is he going to fund it? 5 years. And then he's going to stop altogether. So stops at 5 years. The cash value is positive by year 5, actually a little bit earlier. The death benefit, this is $100,000 per year. Might start out at $2 million. But increases as the cash value increases. You'll always see the death benefit higher than the cash value until I hit 100 years old. At that point, they become equal. But pretty interesting, right? When I look at the approach of how to reduce the insurance expenses and maximize the cash value. What we do in cases like this where someone's interested in the cash value feature is typically start with this so we can just understand the basics of a whole life insurance product and then show you how you turn it into this. So you still have life insurance, but you end up with a very cash-rich policy as well. I hope this video was helpful. Please let us know your thoughts and if you have any questions, and we'll see you in the next video. Thanks again.
Hey guys, Steve here with IBC Global. Thank you so much for watching the video. If you're interested in a whole life insurance policy and you'd like to work with our company in setting it up, please visit our website, ibcglobalinc.com. We would love to work with you. If you have any questions, please leave them in the comments below. And as always, I hope this helps.